Coming out. So I'm one of the organizers of the event. Usually I'm up here introducing someone else much more brighter than me to speak, but so today I'm kind of speaking about analyzing deals is the topic we're going to discuss tonight. So it's going to be real quick. I figure I'll go through in 20 minutes and then answer any questions, and then we can get back to the fun stuff, the networking. So feel free to grab pizza or beer. We should have plenty of it. And yeah, everyone online, we're going to get started here. Sorry, I got kind of two computers going. We got a handful of people watching on Zoom and then manning two computers to set up here. So, okay, so just a little bit of background. So how I kind of got into it is so we do some syndication deals here at Smart Asset Capital. And within our partnership, so we got the other partner right there, Adam just walked in, and the other one's actually on Zoom here in California. So us three kind of banded together to do that. And within that, one of my main roles is the underwriting, the analyzing the deals. So I'd say, roughly over the past year, I've underwrote roughly $100 million worth of deals, kind of a natural fit for me with my educational background and what I do in my W-2 role. And really just one thing to really learn is just through practice is kind of where I've gotten to learn what I've learned is just, obviously the educational piece, but practicing a lot. So dive right into it. So really when you're starting to underwrite a deal, and for those that underwrite, the term refers to analyze. So those terms can be used interchangeably. There's two documents you're really going to need to start digging into analyzing a deal. And those are going to be the trailing 12-month financials, or often referred to as the T12, and then a rent roll, which just breaks down, all the tenants that are in a building, how much you're paying in rent, size of the units, all that. So really the trailing 12-month financials is going to show you the financial picture of the property, right? How is it performing? That's what you're going to need to analyze the deal properly. The rent roll, one thing aside that can be used for is to validate financials. So one thing I'll look at is, does the rent roll match the T12? First thing I always look at is, the total income on the rent roll, does that match the income on the T12? What are the vacancy numbers? Do those match up? Because oftentimes you'll see that those are off a little bit. So always check that. And also the rent roll will allow you to determine if there's room to increase rents, right? Obviously, that's a main strategy you like to do when they come in is, can we boost the rents at all? You can do your own analysis to determine if these units, you bump $50, what does it look like there? Those documents, obviously, you're going to usually obtain them from the broker or the seller, depending on who you're working with. So those are the two documents you're going to need to analyze the deal. Okay, so in just back context, this is the pictures you see in here are in an analyzer that I've kind of just built out on my own. So I just use it as a basis for this presentation. And then the example deal I'm going to use going through this is just a random deal we looked at a long time ago that we didn't get, but as you'll see, we can go through this, numbers didn't work. So on here you got your first step generally, and these steps can kind of change depending on what type of analyzer you're using and what process you're using, but in general, these are the kind of the process the flow you're going to go through. So you got your trailing 12-month financials right there. You're going to input them into your analyzer of choice. A lot of times on the trailing 12-month financials, you'll notice that the income and expense lines are going to vary widely depending on what software they're using, how they're bucketing everything. So you're generally going to break those into different buckets that match your analyzer. So that's one of the first things I do is you might find a few lines matched together, and you'll just bucket them into there. And then just to kind of talk about some of the terms. So as you can see on this analyzer slide here, you got the gross potential rent as that top line item. So that's your income. If the property is 100% occupied, every unit's full, how much money can it stand to bring in? So that's your number right there. Your effective rental income is going to be the income after vacancy and bad debt. So you can see on this one, it's assuming 5% vacancy, and that's what the T12 is showing, 5% vacancy, 0% bad debt. So they're saying 778 grand is what's coming in per year. And then your other income, which could be an array of things, as you can see, parking, laundry. And that ultimately brings it out to the other term is the net operating income. So that's your total net income minus total expenses. So that's probably one of the most important numbers when it comes to determining values of properties is what is the NOI. That's what you're going to determine, divide that by cap rate. That's what you get your purchase price at, and that's what's going to determine what you can sell a property for, what you're going to buy it for. So that's always the main number you want to check there. And I'll touch on that more in the next few slides. But so then the next step would obviously be, we got our acquisition info down here. That's what the purchase price, what they're asking, number of units, and some debt service information there. And I'll kind of touch on more of that as we go through. And anytime if anyone has any questions, feel free to to stop me. So taxes, these are other calculations that are going to go into expenses. So the method to look up, because when you buy a property, almost every time the taxes are going to increase, right? Because you're buying it, most time you're buying it for higher price than what they bought it for. Tax assessor comes in, boosts up your taxes. So how you determine that value? If you want to get real detailed, you can actually call a tax assessor, and a lot of times they'll just give you have a good relationship with them, they'll give you that close number. But the best way to do it, usually just in the initial phases of underwriting, is you can go online and search by county to find the mill rates. So different states will calculate tax increases differently. Wisconsin does it by mill rate. So like I looked up the Milwaukee area, 2.67 mill rate. And then I take the appraisal percentage. So in this example, I'm assuming 100% of the appraisal. So that assumes $146,000 tax amount is what, obviously that's not the exact number, but that's a good way to estimate what it's going to be once you take it over and buy it for the price you're expecting to. Reserves. So this is something very important, especially right now. When you're coming into deals, it's always good to have reserves sitting in the bank for unexpected things like we're going through it now. It's nice to have some cash sitting there to pull from if you need it. So generally I like to do at least 6 months up to 12 months of reserves of every line item. So every single expense line, your mortgage payment, everything that falls in your yearly expense column, 6 months to 12 months of that is usually what I like to bring into closing. And a lot of lenders right now, an agency debt for these larger deals are even requiring that. So you know, up to 18 months, some lenders are requiring. So in escrow at closing. So that's good to know that how many months you want to bring into closing. And then the last thing you're going to calculate here is the rehab budget. So unless you kind of already walked the property and know what you're going to spend on a rehab, if you are going to plan on rehabbing it, at the time of underwriting, usually you're just going to make an educated guess on, say you think, oh, we're going to go in and spend $1,000 on each unit, 50 units. Hey, I'm going to do 50 grand for your rehab budget. Maybe you're not going to rehab at all, and you just keep that at zero because you already have your reserves. And then obviously, once you actually, if you get a deal under contract, that's when you're going to go in and really do a detailed analysis of what the rehab is going to be. And you can then go back in here and adjust that. Okay. So this term, normalizing expenses. So this is really normalizing. So when this term comes out, it's really an educated assumption on what you think you can run the property at. This is where you get your chance to be conservative. Usually you want to assume higher expenses and vacancy in most cases. So what it really is, this is really what you think you're going to run the property at on day one. So again, you want to be conservative in this aspect. Most of the time when you see a 212, they're really pushing the numbers, and they're getting that's the best. Usually when they sell it, they want that property at peak performance. So usually you don't want to assume you're going to run that property at peak performance throughout the whole year. Obviously there's scenarios where you could, but so when you're coming in and you're normalizing it, so that really what I'll do in this stage is, as you can see, you got the T12 column and the normalized column. I bumped up, in this example, I bumped up vacancy 2%. I threw in some bad debt in there as well. So obviously that brings down, right, your net operating income, your total net income considerably right away. But you want to be conservative. I don't want to go in and assume, we're going to run at 5% vacancy and 0% bad debt. You want to kind of normalize that. Then you're going to you can go into and then start combing through the expenses. So like, if your property management fee, you can input that in there. You can look line by line and determine maybe there's some expenses that should be higher that look low, vice versa. This is the normalizing stage is when you're going to do that. Then almost every time, sometimes you see it, but most T12s won't include replacement reserves. So obviously make their net operating income look better. So replacement reserves are another on top of your reserves going into the deal, are like a monthly deposit to keep stacking up that reserve base. So if stuff does go wrong, you're always building that up. A roof goes bad or something, you have that capital to dump in there. So generally, a rule of thumb is $250 per unit per year as the number. That varies. So if you have a really old property, maybe you bump it up to $300. If it's a brand new property, maybe you're $200. And then again, some of the larger lenders do actually require that as well, that you have that deposit. So it's always good to pencil that in because that could be a huge surprise if you're not accounting for it. And then lastly, so once you get through this stage, you're going to look at the expense ratio, right? So generally 50 to 60% range is where you're going to see the expense ratio fall within. So the expense ratio is going to be the percent of expenses of income. So like an A-class building, you might see a 50%, C-class 60%. it's gonna vary there. One thing I'll say, just a quick look, and sometimes it will be, but if you go into a deal and you see they have expenses at 45, 40%, usually there's some sort of red flag in there, unless smaller deals can usually be run at that percentage rate, but often the larger deals are going to be in that 50 to 60% range, depending on the asset class. Okay, so then the debt service information. So debt service is the mortgage, is what it is. That's just a term for it. So what I will generally do, and is a good way to be conservative, is when you're inputting what your mortgage payment you think is going to be. So say you spoke to your lender, last week, they said, yeah, I got you on a 4% interest rate. You get this deal next week. Instead of going in there and plugging in 4%, put 4.25. So 25 to 50 basis points is usually what I like to see, higher than what you're getting quoted at. Because generally, I mean, a deal you can have a contract anywhere from 2 months to 4 months, so on. So a lot can change there. Interest rates could jump up in that time, they could go down. But I'd rather be on the conservative end and bump those up at that time. So always do that. That's crucial, and it's good to always keep a pulse on what interest rates are at. Speaking to your mortgage broker or banker about where they're at today, because those are constantly changing as well. So then at this point, in this example, you'd get to where you can kind of have a quick understanding of where the year one performance falls. Obviously, as you can see down here, this is what their T12 shows. They're showing it at a 6.65 cap. After I normalized everything, I brought it down quite a bit. And those are the numbers I'm going to go off of, or what my projection numbers are. So the cap rate, that's probably a term you hear quite a bit. Like I said, that's the net operating income divided by the purchase price. And that's really what I use it for, is kind of just quick insight of where the price lines up at. I don't necessarily use it as for like an end all be all of what the returns are going to be from the property. It's good for like having conversations with people or like this, where you say, okay, it's at a 5.46 cap. That's low. So and once you start looking at more deals, you gain understanding. So maybe I say, in this part of town, a 7 cap is where it actually makes sense. So I know right away it's overpriced. That's generally what I use a cap rate for, and it should be used for. It shouldn't be used for, I want to buy it because it's a 6 cap and I like a 6 cap. It should just be used as a quick tool to understand the numbers. Cash on cash return, that's another big one. So that's the cash flow divided by the total capital to close, how much money you're bringing into the deal. So as you can see, that's pretty low as well. And the debt coverage ratio, or DCR, that's the net operating income divided by your debt service mortgage payment. So lenders typically like to see that at least at 1.25. If they see it below that, most time they're not even look twice at it. So you want to set a number at 1.25. As you can see, it's pretty close there. But a debt coverage ratio of 1.0 means it covers the mortgage. Anything above that, so the 0.23 above that is your profit. Okay, so then equity summary. So I'm gonna kind of go two directions with this slide. So if you are, and I built this to kind of analyze what we do is the syndication type stuff. I'll quickly explain for those that don't know what syndication is. So syndication really is the general partners. Like I said, there's us three, the general partners, and then the limited partners are investors that come in and partner with us to do these deals. And then as the general partners, you receive kind of like a sweat equity portion of the deal. Like a common one's 80%, 20%. Could be a split. Any dollar that comes in, 80% goes to investors, 20% to general partners type thing. It can get a little more complicated than that, but that's just a quick description of it. So like the limited partners aren't really actively involved in the deal. It's more business syndication. They're more just, partnering up with the silent partner in these deals. So, and then touching a little more on syndication type stuff, and that kind of goes in here with the equity stuff. These are some common fees you might see in a syndication: an acquisition fee, which is a percentage of the purchase price. So 2% is pretty common there. An equity split, like I said, in this example, it's 70-30. Preferred returns, another thing in syndication, where you might offer an 8% preferred return to limited partners. So without getting too complicated, so say every dollar that comes in, the limited partners need to hit an 8% cash on cash return on a yearly basis. As soon as that number's hit, then every dollar gets split 70-30, as well as all capital from refinance or a sale. Asset management fee, that's a percentage of the monthly cash flow. That's kind of, a fee on top of property management that goes with the asset management duties, which can be a lot. I won't go too deep into that, but then a capital transaction, that's not quite as common, but some syndicators will use that. So that's kind of there. Like also, with when I'm analyzing these deals, it also has the option to just void all that and just do it. You're just buying it on your own to do it that way. So then you come to your equity summary down there. So this will give you a snapshot, kind of, this is where you're gonna look at how much, what is the total purchase cost after we factor in, our mortgage, closing costs, the fees, our reserves and rehabs, how much money do we need to close, what is the total cost to buy this deal? And then, so as we go forward, you're gonna see that we're gonna start adjusting numbers, and then that's gonna change as we do that. Okay, so closing costs, just a quick view, and these are actually very conservative, but really, I always like to be even more conservative on the closing costs as well, because the worst case scenario, if you're high on closing costs, just more money you can throw into your reserve when you close. So as you can see, I won't go through each line item, but one thing to note is you are syndicating deals. Legal costs are going to be one of your big barriers to syndication. You're doing full-fledged syndications; those fees can be $15,000 plus for the legal portion of it. So yeah, obviously, depending on the size of the deal, a lot of these costs can be lower or higher. As you can see, it comes out to 119 grand. Likely it's gonna be lower than that, but we're conservative on that front as well. Okay, so then you're gonna come into a real important part of the exit strategy. So when you're going on a deal, obviously, if you're going on yourself, this might not really matter. You might just decide I'm buying it, buying hold forever myself. So this might not really tie into that. But if you're coming in with partners, or you have a strategy of I want to bring in some value and sell it down the road, this is where you determine that. So in this example, I'm assuming we're going to hold it for 8 years and sell at year 8. So another thing to think about when you're doing this is the type of loan you're getting. A lot of commercial banks are just going to do a 5-year term. That's usually the max. So you might not going to have the option to sell at year 8. If you go usually agency debt, you can get 10 to 15-year terms. So that's where that can become an option. But yeah, so say you do a local bank and your strategy might be a refinance at year 5. And then hold for another 5 years and then sell at year 10. When we do commercial loans, those are kind of the strategy we'll generally go for. So in that scenario, just talking through this, you'd fill out kind of the information in here. As you can see, what I'm going to input over here, because we're not refinancing, we're selling. So this is one of the most crucial parts that a lot of people overlook. So at the time, going back to that capitalization rate, the cap rate, you're going to determine what your exit cap rate is. What do you think the cap rate you're going to sell that property at, right? So remember, net operating income divided by cap rate is your purchase price. So what cap rate do you think you're going to sell it at? So you really, this is, and then there's some things out there where you can get real detail on trying to figure out what cap rates are going to be at 10 years from now, but realistically, no one knows where the market's going to be at, 8 to 10 years from now. So just to be conservative, what I do and is smart to do is bump it up at least 50 basis points, even up to 100 basis points higher than what you're buying it at. So in this example, you can see a 9.2 cap, and that kind of goes back to once we adjust the numbers. That would assume we're buying it at 8.7 cap. So I bumped it up 50 basis points to say, we're going to sell it at 9.2 cap 8 years from now. There's a likely chance that 8 years from now cap rates are even lower and you sell it for, a 7 cap. But you don't want to be, because if I change that number to a 7 cap, all of a sudden this deal is the best deal you've seen on earth. Like, the numbers are great. And that's what a lot of people do, is they just plug that number in. And if you're ever looking through deals or looking to invest in deals, that's true. One of the first things you look at is what exit cap they use, because that can turn a horrible deal into a great deal real quick just by putting one number in there. So yeah, 50 basis points to 100 basis points higher than what you're buying it at is a good rule of thumb. So then you get to the profit and loss statement, or the P&L. So this really, what this is used for is it gives you a holistic view of what it looks like over your whole 8-year hold period. This is also where I use it. This can change depending on the analyzer you're using, but I use it to project where we're going to do some value add strategies. So on the up top right, you see those increase assumptions. Those are the rent increase and expense increase as a percentage basis. So 3% is pretty common in the past. That's usually where the target of inflation is. So 3% usually mirrors that. Inflation is really where 2 to 3% range is kind of common. But in this instance, we assumed we could bump rents up. So as you can see, in year 3 and 4, I bump rents up 6%, because after some back end analysis, I assumed that's where we can get to. So that's where I bump it up. And as you can see, in year 1, I assume no rent increase. I assume we're going to come in, rents are going to stay the same for the first year. And even right now, it's even better probably after the first 2 years, because there's a good chance rents aren't going up anywhere in the current state of the economy. So yeah, so two tips there. When you're increasing your rents, so like in year 3 and 4, I bumped it up 6%. Increase your vacancy as well. As you can see, I did 10% vacancy in year 3, 10% vacancy in year 4. Because when you're bumping up rents, almost always tenants are going to move out. They don't want to pay the increase, so they move out. So account for that a few tenants are going to move out. Bump that up a little bit. Also mirror the expenses. I assume that if rents are going up, that means we're putting some money into the property. There's going to be some more costs. So let's bump the expense up as well, so those numbers even out. It's not unfair on one side or the other. So yeah, that's really what a P&L will look like. Then value add strategy, you heard me say that before. So really when people say value add, what it comes down to is increasing the net operating income. That's how you add value to a property, is increasing that number. So there's literally hundreds of ways to do it. Some of the most common ones are increasing rents, adding additional income sources like laundry, parking, ratio utility billing systems. That's just charging back like water or different utilities. You can add in different fees. You could decrease expenses. Maybe the property is 80% occupied. You think you can get it to 95. Those are just a few of the common ones of implementing a value add strategy, which is a real common investment strategy. So going back, so as you saw on that previous P&L slide, the returns didn't look too good. So at this point, these are a few of the options I would consider. Obviously, the easy one, just go bump the offer price down so the numbers work. Or you could even go back and adjust the syndication split if you are syndicating. Maybe you lower your equity or get rid of some of your fees to make the numbers work. Maybe you change your hold strategy. Maybe you bump it up to a 10-year hold, and all of a sudden the numbers look a little better now. Or you just say no to the deal right away because you know it's not going to work. In this instance, just keep it basic. I just adjust the purchase price down to where the numbers started to work. So came out to asking price 5.5. The numbers worked at 3.85. So as you can tell, we didn't get this deal. So yeah, that's really, you can get more creative there, but just kind of making sure that's my main thing is always, I want the returns to work. How are we going to make it work without sacrificing too much? And usually that purchase price is the first thing to start bumping down. And then, so last, the return metrics. So this is where you get to the end. This is where detail analysis of what the returns look like. So side note again, if you're a syndication, always look at the limited partner returns. Don't look at the overall project returns, because first and foremost with syndication, it's all about providing returns to your investors. It doesn't really matter what the overall project return is. It's about what the investors are making. So as you can see, that's kind of the numbers we're looking at here, is what their split returns are. So a few of the metrics to look at, average cash on cash return. So this is an average over the entire hold period, which is going to be your initial equity investment divided by cash flow on an average yearly basis. I like to see it anywhere from 8 to 12% averaged out. So as you can see, it hits that number. Average annual return, that's the average amount investors will earn each year over a given period of time. So really what that is, the cash on cash return plus any proceeds from a refinance or sale is the easy way to look at it. That the average annual return encompasses that number. Internal rate of return. So this is probably my favorite metric to look at, and probably the most complicated. It's real. I won't get too detailed in describing it, but essentially what it is the interest rate at which the net present value of all the cash flows equals 0, or it takes into consideration the time value of money. If a dollar is invested a certain period over a certain amount of years, what does it look like when it's invested at that time period? So 15% usually is pretty common there. I like to see at least that or a little bit higher. Then the two easier ones, total return on investment, such as the total return divided by the total cost. And then your equity multiple, which kind of mirrors that. So like an equity multiple of 2 would mean you doubled your money over the whole period. So those are some of the common ones to look at. And then the last piece I look at is the stress test. So before locking in the final offer price, you get to that point, all right, the returns are there. The last thing you want to do is make sure that it passes stress tests. These are the two that I look at. The first is just the recession-proof test is what I call it. So I factor in, at year 1 off our normalized expenses, or actually you can look at it normalized or the T12 numbers. If the income were to pull back 8% and vacancy 15%, does it still cash flow? So where I came about that is in the 2008 recession, 14.8% was the average vacancy nationally. Actually, rents kind of stayed the same throughout that period at a national level. So it's even more conservative than the 2008 recession. But you want to make sure, as you can see, it's still cash flowing 65 grand. So yes, it does pass there. break-even occupancy. So that's percent of economic occupancy at which the cash flow is equal to 0. So economic occupancy, for those that don't know, is any unit that you're not receiving rent from. So say there's 10 units that are no one living in, there's another 3 that people are living there but they're not paying rent. That's your economic vacancy, the total amount of units that you're not receiving rent from. So the break-even occupancy, so this is really going to tell you what that max number is. So I like to see at least 75% or lower. That's a good, so that means, if we go 25% economic vacancy, we can still hit all of our expenses and all of our mortgage. We're not losing any money. So as you can see, it's at 31%. So that pass on both of those fronts. Yeah, and then just, I don't even know why I really added this, but kind of, yeah, I mean, just going through and to really learn it, I mean, it just really takes practice, learn the basics, and then go through and just, when I started, I would literally just go on like LoopNet or whatever and find deals that look kind of in my target range, just practice analyzing them to gain confidence and understanding the numbers before I started talking with brokers. Because when you start talking with brokers, you can turn a broker off real quick. You kind of don't really know what you're talking about. So it's better to understand stuff and then go in, have an educated conversation is what I've found, at least. And then lastly, not turn into a picture or anything, but this analyzer that I was going through, I did recently post up on our website for sale with some, I have like 10-part video series of some educational stuff. If people are looking to learn more about the syndication analyzing stuff, it's doing it for $89 right now. At that link, there's a flyer over at the front as well. And then, yeah, so that's it. If anyone has any questions.
What was the property that this analyzed? Was it a multi-family portfolio? Was it an apartment building with? It
was one apartment building. I think it was 70-something units. Yeah, and in like a C-class area. Okay. So this was, I just pulled up one. I didn't want to pull up anything too recent, so I pulled up something like a year ago that I really, yeah, it's something from a while ago, I think. So yeah, something we didn't end up getting.
For the closing costs, do you have a rule of thumb percentage of the cost that you used? So,
yeah. So essentially, let's see if I can go back. So yeah, as you can see, a lot of these, like an origination fee. Some bankers are going to take 1% of the total cost there. So that's automatically calculated. Like a title policy, 0.5% is pretty common. A lot of those numbers are conservative. Title policy can be anywhere from like 0.3% to like 0.6.
But your total closing cost, do you find it sort of shakes out at about 4% or 5%?
Yeah, realistically, when I look back at some of our recent deals, it's more around like 2% or like 0.2%. But again, just being kind of conservative there because it will, depend on the type of deal and stuff. So yeah, these are really like kind of rough numbers. They're actually really high compared to what actually it's going to be. So sometimes I'll go through and I might fine tune some of these numbers. I'm trying to, play around and make the numbers, pencil out at the end. This is something you might be able to play around a little bit. I won't go too crazy on, lowering these costs, but these set numbers right here, there is definitely a little bit of room to bring those down.
So what would you recommend as a total closing cost of the ballpark figure that you could to factor in? You're saying like 1%, 2%?
Yeah, it's a good question. I don't know if I've ever looked at it as like a percentage of, total purchase cost. I guess more so I just look at it like an individual base, like legal fees. Say if you're not syndicating a deal, you can bump that out right away. If it's a smaller deal, you're not going to have $3,000 in attorney fees. Stuff like that, you kind of bump around. If it's an environmental report, a lot of times they don't require that. So I guess that's a good question. I guess I never looked at like what percentage of it is a purchase price, a quick and dirty percentage. So
that's what I mean. Like just
yeah. I'm sure there is. Yeah, there's got to be kind of a rough number for that. Yeah.
And it's kind of a two-part question. You keep saying in a good way that you analyze this. Is it just you, or do you have a team? And in addition, can you do this in a day, a week, a month? Especially when the market's hot. Like, how fast could you run through all this in order to get a deal to happen?
Yeah. So yeah, within our partnership, I mean, we all look at the deals. That's definitely my kind of strong suit that I brought to our partnership is this side of it. But at first, I mean, I remember first looking at deals that we were serious on, I'd spend 4 or 5 hours looking at, in the spreadsheet, looking through it. Now I can kind of go through that. If it's a deal that we're offering on and we're going to buy, I'll still spend, it takes a few hours to go through and really look through it. But once you kind of used to it, you can tell pretty quickly if, you pull up that T12 and you toss numbers in there, you can tell within 5-10 minutes, yeah, this deal's not going to work. I don't like it. So the more you do it, the quicker you're going to get. But Then again, those deals you do actually go all in on, plan to spend at least a couple hours in there, like really fine tuning, doing, your research on where rents are and all that stuff will take a while. But once you really get used to the market and where prices are at and what expense ratios are at, you can generally tell pretty quickly, like within 5-10 minutes, this deal doesn't work.
Do you, with this one, it was a pretty big difference from the asking price, right? Is this big enough that we would even bother?
I to be honest, yeah, I don't think we even put an offer on this one. Yeah, no, we were way off on that one. And I think I know someone coming in buying it that wasn't syndicating it. They just bought it like that, where the numbers obviously are going to work a little easier if you don't have those syndication splits in there.
So, like, I'm lucky enough to have you to do the analyzing for us, because it's a lot, right? I mean, there's a lot of data there. Somebody like Dylan here to my left, who's just not here as smart as you, like, how does he analyze it? He can't do all that. What's a simpler way to just be realistic, to know if it's a good deal or not? Do you have any advice for that?
Yeah, I guess, so it depends if syndication, analyzing the syndication stuff, definitely there's that extra layer, right, with the splits and all that, where that adds the complexity to it. If it's not a syndication, really you could just build something where you just plug in expense. You could even be rougher and dirty and say 55% expense ratio, just assume that. Stuff like that, where it kind of depends on, I don't know if I have an exact answer for it. I think it depends. If it's not a syndication, I think it's a lot easier where you can just plug numbers in and assume so based off, just like an online calculator. But most of the online calculators you see are going to encompass the syndication stuff. I found is you need a spreadsheet to deeply analyze a syndication deal.
To that question, I reckon if you know what the rent roll is, so you know the income, and you did a guesstimate that says it's going to be 55% of expenses, and then you threw out it's going to be 1%, 2% of closing costs.
Yep.
Then you've got a quick and dirty way to say, where is this going to land? And if it looks half decent, then you know if you drill in a bit more to see if you missed it. But to me, it sounds like, just reading between the lines of what you're saying here, there's a lot of detail, but if you took that higher level, you'd probably get a bit of an idea of whether this could, if it's close enough, you might think, oh, it's worthwhile digging deeper there. Or it looks like it's so far off, it's not even worth digging.
Exactly. Yeah, and that's, I know when I started out looking at duplex stuff, I just built a one-page spreadsheet or just income, expenses, mortgage payment, return kind of type thing, where on a basic level that'll do.
Yeah, because honestly, I felt it easy to do duplexes, right? So I did duplexes, and then I want to get into multifamilies, and then I just got lost in all the complexity and all the gross stuff. And then I took a step back, and then I thought, hey, what if I just took in it, assuming it's just a duplex? And then I walked in, and I thought, hey, the numbers are going to be different, but key things, I think the big one is, what is a reasonable cap rate? I think it's a big one. If you don't know that, then you're going to be miles out potentially.
Exactly.
And especially like you said, if you're going to plan to sell, you get the cap rate wrong there, then you can make the numbers look fantastic. Right?
Yep.
So there, to me, they're the two things that I, as a sort of a beginner, that's the part where I think I got no idea to know what in this area is a going cap rate that's reasonable to expect.
Yeah, no, that's a great point. Yeah, and like I said too, if you have an exit strategy, that adds a whole nother level to complexity. If you're just holding it forever, you don't really care about what the year one is, because then you just assume it's going to continue or get better. But if you're planning on selling in 5 years, then you got to start modeling out what does that sale look like in 5 years, what are the returns in that period. So I think that's where it adds that complexity, is when you start adding in these different variables with partnerships.
Yeah, because definitely to me it seems in multifamily that's a huge benefit that you get, is that extra strategy potential.
Yep.
If you take something that's not operating very well, vacancies are low, then if you can get that to where it needs to be, then you can be on a gold mine.
Yep.
It's just trying to find that. It's the key. But if you overestimate what your cap rate's going to be.
That's, yeah, exactly. And there's a lot of, definitely got to be conservative on that front with the cap rates. So. Anyone else? All right. Well, thank you.